Hello, good evening, everyone. Welcome to our Thriving Thursday Live. We're here with First Home Alliance, and we have a crew here with you tonight. We have Victor back, and of course, we have a special guest. He's bringing a guest in, Robert. And I'm going to go ahead and just let Charlene talk to you guys. And if you have not liked or subscribed, please do so. We're trying to grow a community here, and we will grow the community that we want to continue to empower you with knowledge and bring you special guests each week to make your financial stability possible and stabilize your housing situation. So tonight, we're going to let Charlene go ahead and get started, and then we'll introduce our speakers for tonight. Charlene.
All right. Thanks, Larry. Again, thank you everyone for joining us, whether you're on Facebook or YouTube. Let me tell you a little bit about First Home Alliance before we get into our Thriving Thursday and our conversation for tonight. First Home Alliance, we are a HUD-approved housing counseling agency. We was established by our president and founder, Mr. Larry J. Laws. The inception came from his mother purchased her first home at the age of 65. After serving his country, he decided to serve his community, and that's how the inception of First Home Alliance came about. Now, what is First Home Alliance mission? So our mission is to increase home ownership to low to moderate income family, sustainable home ownership to low to moderate income family, along with serving our veteran community. Now, what are the services that First Home Alliance provide? We provide pre-purchase counseling as well as education, loss mitigation services. What is that? I'm experiencing a hardship right now, and I need someone to act as an advocate on my behalf. First Home Alliance steps in and tries to do that. We act as an advocate to get that monthly payment more to affordable dollar amount, but the main thing is to protect the homeowner's assets and make sure that they do not, or you do not experience foreclosure. We also offer rental counseling as well as debt budget management, credit counseling, and emergency preparedness. Now, where are these services provided? We are located in Virginia, Maryland, as well as the south side of Chicago. But I'm quite sure you guys are tired of hearing me say it every single week because I say the same thing. It doesn't matter where you're located. First Home Alliance can assist. We have went virtual. We've been virtual since I think February or March of 2020. So it doesn't matter where you're located. If some of the services that I just discussed piques your interest, we want you to stay tuned, listen to our Thriving Thursday conversation. But at the end, we will talk to you how you can get those services from us. Larry?
Yes, welcome again to our Thriving Thursday here. And we want, again, join our community, subscribe, of course, and expand the community. So share this on your social media platforms, and please drop your comments. We need your comments. You have opportunity to put stars out there. You can put your likes out there. So go ahead and hit those comments, hit those stars. We need to see the community grow. And we're looking for comments. We're live at this time on Facebook. We're live on YouTube, and we're also live on Facebook. I say Facebook. So go ahead. We're going to probably jump over on Instagram as well. And so share this on your social media platforms, expand our community. And if you're catching this on replay, some of you guys may be catching it on replay, we want to say thank you for joining us. And go ahead and you can put your comments out there, even though it's a replay, and we will try to get your comments answered. We'll respond to that. Okay, without further ado, we're going to go ahead and get started this evening. And back to the studio again is Victor. Victor, welcome. How are you doing?
Doing great, Larry. Thank you for having me this evening on this Driving Thursday. And today we bring you, each and every one of our viewers, the topic of retirement and to unlock your superpowers of retirement. Again, for those that are joining for the first time, my name is Victor Ludina. I'm a financial agent with World Financial Group and also partnership with World System Builder, a proud builder. We have a mission to educate 30 million people by the year 2030, and we bring education, we bring a platform. So, Larry, I'm so excited today because we have a lot of content that we're going to cover, and we're going to bring a lot of value, hope to bring a lot of value to our viewers. So let's make sure we could keep the conversation going. But I would like to introduce Rob here, as you can all see. So I have the pleasure to introduce Rob here. Rob, he's one of the leaders here in the campaign. He's been in the financial industry for more than 10 years, and he and his wife has helped millions of customers or people with financial planning. So, and his military background, he's a great dad, and he's just an inspiring person, and he has a great heart to help out everybody. So thank you, Rob, for taking that time being here, sharing this space with me as we educate our viewers, our community, and I think we're going to bring a lot of value with our retirement, education today.
Okay, awesome. Thank you, Victor. And hello, everybody out there. Thank you, Larry and Charlene. I appreciate it. So I'll go ahead and get started. I know time is of the essence. And of course, when you're thinking about retirement, it seems like such a short period of time between pulling the trigger of, yes, I'm ready, and oh, maybe I'm not. So hopefully we can help you at least get started down the path of figuring out whether or not you're on track or you're off track or where you're headed. I also thank you, Victor. I spent 11 and a half years in the Air Force. I was in IT. I got my degree in computer science. I became a principal engineer. I owned a government contracting business in the DC Metro, and I sold that to get into finance with my lovely bride, Raquel. So we have 4 children. We have an 11-year-old. We've got a 2-year-old. We've got a 7-month-old. We've got a 3-month-old. So lots of little ones. If you're trying to do the biological math there, don't worry. We're using gestational carrier. So that's how we end up with a 7 and a 3-month. And you're like, that, have you been doing something you shouldn't have been doing, Rob? So, no, we're okay with that. So I know tonight's topic is going to be retirement. So, and just a little background on our organization. We've been around for about 40 years now. We are a full service financial firm. So I'm a licensed investment advisor. I'm a registered representative, licensed producer. I'm a fiduciary, all of those fun things, but we love the financial education. We have 6 financial workshops. We have taught these workshops at the FBI in both DC and Northern Virginia. We've taught them at Columbia University, Harvard University, Oracle, L'Oreal, the Chicago Police Department, Alexandria Sheriff's Department, lots of businesses, churches, anywhere that people want to learn about money. We do that. And we also do it 100% free of charge. You're given a workbook that you can follow along with. So if you have organizations that you would like to bring us into, or at least have the conversation, we're more than happy to do that. So that we can just get our number closer to 300 or 30 million by the year 2030. That's ultimately our goal. So tonight, I'm going to focus on, I'm going to jump around between different workshops, just A, so you can see it, but B, because I want it to really be concise when it comes to the time that we have together and focused on retirement, because it's going to come with a lot of questions of, am I ready? Do I have enough? Am I on track? Right. And we think, okay, there should be some steps, or there should be some sort of, I'm going to try to share my screen. I've never used this platform, so this is going to be unique. Let me see here, video, image, slides, and PDF. Oh, I see. Okay. All right. So it works very much like that. Let me just do this. No. So I can only, here we are. I got it. I'm getting there. Look at me go, IT guy. Okay, here we go. All right. So everybody should be able to see the screen. Is that correct?
Yes.
Okay, perfect. Okay. So the big question, of course, is always, are we ready to retire? Are the kids grown? Are they not grown? Are they still sometimes living at home? Did you pay for their college? Are they still in college? Are all of your debts paid? Do you have a full emergency fund? And, of course, do we have enough when it comes to investments? Now, really, it's going to come back to, let me come to this because I want to jump backwards a little bit here real quick. Right here. It's going to come back to this financial foundation. And when we're talking about financial planning or wealth building or estate planning or college planning, you name it, we have to make sure that we have structure behind it. And for us, that means having a proper financial foundation. So I have to have proper protection in place, meaning all the insurances. I have health insurance, disability if it's needed, long-term care. I have life insurance as well. I have insurance that's protecting my assets, whether it's my home, my cars, my jewelry, my investments. I want to make sure that they're all protected so that if there is a market downturn, I don't have to worry about it. Or if there is a tragic issue in my life, again, it doesn't have to derail my retirement. Debt management. We are not a debt consolidation company. We do represent over 191 different financial companies like Pac Life and Prudential and Nationwide and Fidelity and BlackRock and American Funds, John Hancock, Lloyd's of London, you name it, we represent them. But we don't do really debt consolidation or loans. That we leave to others. However, we need to plan for our wealth, but we also need to plan for our debt. So the first thing we have to do is figure out, how do I get out of debt sooner? So there's a method called debt roll-up or debt snowball that can help you get out of debt much sooner. I'm going to go over that in a moment. Then we have to have a proper emergency fund. What does a proper emergency fund look like? It should be at least 6 months of your gross income. That's a starting point. So if you have a $0 emergency fund, and that's with a D, so don't look at that as emergency fund, because if you do that, that's going to be a problem, right? So you're going to have that emergency money go out the window. No, that money is there so that if the car breaks down, government shutdown like right now, if you have a good emergency fund, you're not sweating whether or not the bills get paid, the family gets taken care of, because you have that cash sitting there. And it doesn't necessarily have to be sitting in a bank earning 0%. It can actually be earning a lot more money and still very, very liquid for you. And lastly, we have to talk about our investments. This is our retirement money. This is our money that we're planning on big projects with, whether it's a second home, it's the beach house, kids' education, all of those things. When it comes to retirement, though, you're going to need at least 20 times your current income or $2 million, whichever is greater, to properly retire. So it used to be $1 million. Today, nowadays, with inflation, it has grown to $2 million. The reason is because if I have $2 million in some form of assets, it doesn't matter really if it's in a 401k or a 403b or an IRA, or if it's in a brokerage account or wherever, that money, if I access it properly and I take care of it properly, if I take out 5% per year, that's $100,000 per year, and I'll never run out of money. Even very conservatively, I'm not worried about depleting all my resources when it comes to retirement. So if I have 20 times my income, so if you're making $200,000 a year right now, you're going to need about $4 million for a good retirement. Now, if you're sitting at zero today and you're like, that doesn't help me, Rob, I'm 50 years old and, retirement's kind of around the corner and I don't really have the retirement setup that I want, that's okay too. We still have to put money aside today to increase that retirement and have a better outlook when it comes to our retirement down the road. So making sure that you understand how this is built from the ground up and putting the pieces in place, doesn't matter how old you are. It doesn't matter how much money you're making. What matters is how much do you keep. That's at the end of the day, that's what matters. So helping people understand how to construct this financial house is very, very important. So what I want to really focus on here now, I'm going to ignore that one. Let me jump down here and talk about the three-legged stool, because this is really on the investment side where our money is at. We have three legs of our retirement money, for lack of a better word. If you are lucky, you have company pensions, or if you're a federal employee or a state employee, you do have a pension plan. You're very blessed. However, just to let you know, it won't affect you as a current employee. Well, they can still change the rules because you do not sign a contract with your pension. However, they are phasing out the federal pension system. That's why TSP came around. That's why it was created. And OPM plans on having retainability through bonuses and those types of things. So at some point that federal pension will go away. Once the federal pension goes away, states will follow. They're expensive to maintain. People are living a lot longer. They're drawing down on those pensions, and it's creating problems for them. You have Social Security as well, which we know, of course, is not that secure. It constantly threatens to run out within 8 years. They've just changed the rules again when it comes to Social Security. What will it look like when you actually go to draw Social Security? Nobody knows. I can't tell you. Nobody can tell you because they haven't written it yet, right? By the time you get ready to retire, it may look completely different than what it is today. So the only thing that I can rely upon is my personal savings. That's money I save, not just in the bank and in the checking account, but that's money that I have control over. My 401k, my 403b, my IRAs, my Roth IRAs, my TSP, any type of investment that I'm saving money into, I control that account and I can dictate what that actually looks like at the end of the day. The other two, I cannot necessarily rely upon. Company pensions are not guaranteed. The only thing that's guaranteed from a company pension is 10%. So can they reduce it while you're on pension? Yes, they can. They can start reducing that if the pension gets into trouble. And there's not one thing anyone can do about it. You can take it to court, but you're probably going to lose at the end of the day. If you did a Google search of company pensions and insolvency, you'll get page after page of company pensions going insolvent because they do run out of money. So let's first talk about Social Security because obviously that's a big thing. This slide has changed, so we have to update it. It has to go through compliance. We will. It's changed a little bit, meaning you now get 100% at age 67 instead of 66. So these numbers basically are going to get shifted to the right. Those percentages. Can you take it early at age 62? You still can. However, the reduction is going to be a little bit more. So you can get a smaller amount, but you can get it technically for a longer period of time. The longer you wait, the more money you're going to get. Well, this is your money, actually. So Social Security was never designed to be a retirement plan. When it was created in 1935, there were 40 people paying into Social Security for every one taking out. Today, there's less than 2 people paying in for every one taking out. So the math just doesn't work out. By the time some of us get to this actually accessing the money we've paid into this program, I have a feeling that the retirement age will be 75 by then, and they're going to shift all these numbers further down the range. And that's going to, not be very appealing for people. However, this is the only thing we got when it comes to the federal government, when it comes to them giving us money, our money back, I should say. And of course, this is where your Medicare premium is also going to be taken from. So when you qualify for Medicare and you go to file through Social Security, they just deduct the premium from your Social Security check. If you are in a good position financially and you have 401ks and Roth IRAs and Roth 401ks and TSPs and brokerage accounts and annuities and all these different things sitting out there, and you're able to draw that income out, that's wonderful. You're going to have a very good retirement, but they will also shrink your Social Security check because you are drawing other income. And for every dollar you take as income from other sources, they will reduce your Social Security check as well. So you got to love our wonderful government when it comes to that. Of course, what is that going to be enough? So when we talk about planning out your retirement, you want to know what your baseline is. And what I mean by that is you can go to SSA.gov today yourself, create your account, and they will tell you what your benefit should look like when you decide to retire. And they'll give you all the ages and what that would look like for each of the years. But that's just one facet of your retirement. You have to figure out where the other money is coming from. So in retirement, you also have to figure out, are my debts paid? Am I still going to have a house payment? What are my monthly needs going to be? Is it going to be $10,000 a month? Is it going to be $15,000 a month? Is it going to be $3,000 a month? Everybody's going to be in a different position, but you do not want to reduce your lifestyle, I should say, just because you are in retirement. The goal is to work very hard and have a better retirement or better life in retirement than you did when you were working, right? That's ultimately the goal. However, life gets in the way. Money is tough sometimes, and life is difficult sometimes, and hard choices need to be made for sure. I understand, I have clients that at times they have to make the choice. Do I pay my rent or Do I save money in my 401k? Well, they got to pay their rent because they need a house, a roof over their head, and that's what they needed to do. So I understand those choices need to be made, but we still have to figure out, okay, what is my retirement going to look like? I don't want it to rely upon just Social Security. So you have to figure out what those sources of income are actually going to be when it comes to your personal savings. Now, for pension plans, if you have one, it's very expensive, of course, for the employer. You are not in control of that money. It is the pension company that's in charge of that money, or your union who hires a pension company that is in charge of that. And they set the rules. There's no contract between you and them, and they can decide to take it at any point, should they decide to take it or shrink it or do whatever. That is 100% their choice. Can you complain? You can. Will it have an effect? Probably not. The math is the math. So if they are threatened with going insolvent, there are requirements that they would have to shrink the payouts each and every month, so that the policy, so their pension plan could last for the lifetime of all the employees. So that's just something to be aware of if you do have a pension plan. Now, you also have your personal savings. Of course, Social Security is not going to be enough, so we have to figure out, where's my money going to sit, right? And what does it look like when I start taking that money out? So it does matter when it comes to retirement where you save your money. Every day that you're saving $1, I don't care where you're saving it, you need to have a goal for that dollar. Is saving that dollar for retirement? Is it saving that dollar for a second house or your first house? Is saving that dollar for your kids' education? What is the purpose of that dollar? That will dictate the type of account that it's going to go into. When it comes to the type of account, what I mean by that is, let me share another screen here real quick, because I want to jump into taxes before I jump into those items real quick. Workshop 1. Not that one, not that one. Oh, I think I can pick this one here. One moment. Nope. Let me pick the different one. Sorry, folks. 2, 5, 5, 6, 2, 6. Did I not bring up 1? I did. Perfect. Okay, let me share my screen again. Screen, don't show that again. Window, and this one. No, that's emergency fund. It's good to have multiple presentations up. This one here. And let me talk about taxes. Because Uncle Sam, you have a choice on, when it comes to building wealth, what you do with your taxes. And we'll cover the rule of 72 in a moment here. So you have 3 options when it comes to taxes. You have tax now accounts. This is where your brokerage accounts are going to be. This is where your checking and savings accounts are at. So if you're earning 10% per year in a brokerage account, that's a tax now account. You pay taxes on the 10% this year. So what you net is going to be about 6%. So that's not a big deal. You may not think it's a big deal, but I'll show you when it comes to the rule of 72 that is actually a very big deal. Then you have tax later or tax deferred. This is where all your 401ks, your 403bs, your TSP, your traditional IRAs, your pension is here. Technically, your Social Security is here as well. When you save money in a tax deferred account, you do not pay taxes on that money today. But when you go to access the money, you not only pay taxes on the money you put in, but also all of the gains as well. So the last option you have is what's called tax advantage. Here you have Roth IRAs, Roth 401ks, Roth 403bs, Roth TSP, 529s, municipal bonds, life insurance with cash value. Here you pay taxes on the money going in. As it grows, you don't pay any taxes. And as long as you follow the rules of the account, you will pay 0 in taxes legally. So if you're earning 10% annually here, you get to keep all 10%. When it comes to tax later, if you're earning 10% per year, you're not paying every year on those taxes, but I cannot tell you what taxes are going to be like when you access the money. So that's the downside of a tax advantaged account. Many people think that when you retire, you automatically get put into a lower tax bracket. The tax code does not care about your age. The tax code cares about how much income you have coming in. So the more income you have coming in, the higher tax bracket you are, regardless of what age you are. So how do we figure out what rates of return we should be looking at, or how to calculate how fast my money's going to grow? And we can utilize something called the rule of 72. So the rule of 72 is very, very simple. It's a very simple math equation. And Albert Einstein called this the greatest mathematical equation of all time. And what it is you take that rate of return, whatever your rate of return is, you divide it into 72, and it's going to give you a number. That number is the number of years it will take for your money to double. So right now, if you're saving money at an account that's earning 4% interest, every 18 years, that money will double every single 18 years, not assuming you're putting more money in and those types of things. Compounding interest does work. It's very powerful, and you need to understand it. Those that don't understand it, unfortunately, will not have a good retirement. So if you're earning 4%, and there's a lot of places right now you can get 4%. And what I mean by that is there's a lot of banks right now that are still paying 4%. Bank of America, unfortunately, is not. They're paying 0.01%. So if I divide 0.01 into 72, that means whatever money I have sitting there and I don't add any more, it will double in 7,200 years. However, there are online banks that you can get access to 4%. There's some brick and mortars as well that will offer 4%, and your money will double every 18 years. Much better for your money. Now, is that really where you're going to build your wealth and get wealthy? No, but I would rather have my money double every 18 years than double every 7,200 years. So in this scenario here, let's say you have a 401k and you have 3 mutual funds in there, and one of them's earning 6%. So that means every 12 years, that money will double, and you have $10,000 in the account. So that means every 12 years, that money doubles until you hit year 36. It doubled 3 times. You have $81,000. If you're earning 8%, just a 2% difference, and you have the $10,000 in there, it doubles every 9 years. So by the time you hit year 36, you have $160,000. So even though you've only added a 2% difference, you've actually doubled your output. And if you're earning 10%, now it doubles every 7.2 years, same amount of money, same amount of time. The difference is you end up with $309,000. Now, if you remember when I talked about Uncle Sam, if you're earning 10% in a tax now account, like a brokerage account, can you get 10%? Yeah, you can still get 10%. That's not a really a huge deal. And let's say you do that, you invest $10,000, it's averaging 10%, but you're paying taxes on that 10% every single year. You actually end up in your pocket with 6%. So after 36 years, you have $81,000 versus $309,000. If you're earning 10% in a tax deferred account, your 401k, your 403b, your TSP, traditional TSP, and you don't pay any taxes on the $10,000 today, you're not going to pay any taxes while it's in the account. And as long as you wait till 59 and a half, which is the IRS trigger date, you can take out that $309,000, but you have to pay taxes on the entire $309,000. So even if you're at a 25% tax bracket, you're still going to end up paying about $80,000 in taxes to Uncle Sam. But then you have that tax advantage column where you put that $10,000 in today, you pay taxes on the $10,000 today. So you may need $13,000 to $14,000 net, and so they're gross, so that you can net $10,000. You invest it, just let it sit there and grow at 10% annually. When it grows to $309,000, you get access to all $309,000 without paying any taxes. So it's important to know that you can be a very good saver but you can execute in the wrong locations, right? So if I'm doing tax deferred, the downside of a tax deferred is sort of like if the bank is going to give me a loan and they don't tell me what the rate is for the interest. And they'll tell me, oh, well, in 10 years, we'll tell you what the interest rate is. That's not a good loan, but that's exactly what's taking place when we talk about tax deferred accounts. So you can do this in reverse as well. So in essence, if you have a credit card that you're paying 18% on and you divide that into 72 and you're not paying on that credit card every 4 years, that debt will double, right? So it's important to know that money does make money. And if we don't pay down these high interest or high credit cards, that it can eat away at our wealth very, very quickly. So when it comes to, let me jump here real quick, those items there I covered. We have to figure out when we build wealth, we have to look at one thing. I've already talked about that. Let me jump up to wealth formula. So if you save $100 and you're gaining a 4% rate of return, you pay taxes on that $4. So that's a $1 deduction. You net $103. If we subtract inflation, which has averaged about 3% over the last 90 years, you're going to talk about a $3 loss in your money. So you actually have zero gain. You just maintained your $100. So when it comes to rates of return, there's a couple things I can control here, and there's a couple things I can't. Number one, I can control the rate of interest to a degree, meaning if I'm earning 0.01%, can I put it somewhere else that I'm earning higher than that? Yes, I can control that. If I have investments that are in the market, yes, I'm subject to market fluctuation. However, I can make adjustments accordingly and try to minimize my losses. And then lastly, we have our taxes, of course, and I can avoid that if I save in the right locations. When it comes to the gains, the principal, you're always going to pay taxes on either in the beginning or at the end. There's no way to escape that, unfortunately. And then inflation, I can't control. The faster the government prints money, that means the money I currently have is worth that much less. So I have to do my best to make sure my rate of return is as high as possible, so that my money is growing as fast as possible, so that I can accomplish the goals that I want to do when it comes to retirement. Now, when it comes to what you have, let me come in retirement here. Let me jump back in this real quick. Let's share this screen and come to, I want 6. Here we are. Okay, so when it comes to different types of investments or retirement accounts that you may have, if you have a 401k, you have a 403b, you have TSP, you have Roth versions of those accounts, most of the time in there is what you would call a mutual fund. If you're not sure what a mutual fund is, it's a great way to diversify your dollars so you're not married to one particular company. You get to diversify your money and try to minimize your loss as well as maximize your gain with those mutual funds. There are also ETFs as well, or exchange traded funds. They're much more affordable. However, an AI is the one that's actually managing those. Which one is better? It depends. ETFs are becoming more and more popular. They have their shortcomings, but mutual funds as well. They've been around for about 300 years. They have their shortcomings too. However, we still have to invest some of our money into the market so that we can grow it as fast as possible. What your risk tolerance is going to depend upon a lot of things. It's going to depend upon your view of money and risk and loss. And it's also going to be determined based upon your retirement years, whenever you plan on retiring. So if your retirement horizon is 10 years away, you may be a little more conservative than somebody that has a retirement horizon of 30 years. It's going to vary from person to person. Now, when it comes to mutual funds, again, they have their advantages. They are very liquid if you have them in a brokerage account. If you have them in your retirement account, you have other choices as well, meaning there are ways that you can do a self-directed 401k even with your own company. They have options out there where you can that way get an advisor like myself to help you out and give you more investment choices outside of what your employer offers. Please talk to a financial professional that they can help you out with that, or you can contact myself or Victor as well. And then, of course, they have professional money management when it comes to mutual funds, meaning there's actually people there every single day that's focused on that money to try to grow it as fast as possible. I know right now the market's doing well, but it is cyclical. It will go back down at some point. I'm going to skip over this one here and come into your 401k. If you're not familiar with what it is, it's just an IRS code. Companies do match sometimes. That has changed as well over the years. It used to be that they would match every contribution you would make. However, thanks to companies like IBM, they now match on December 31st. But if you are terminated or you're laid off or you quit, you don't get any match for the entire year. So that is also changing when it comes to dealing with these companies' 401ks. If you have a 403b, that means you can be an employee of a state organization, a hospital, a nonprofit organization. 457 are for your public employees, police department, fire department, FBI. Those folks are forced to retire early so they can access that 457 money before the age of 59 and a half. All of your 401k money, your 403b money, your TSP money, those you have to wait until 59 and a half. If you try to access it early, you will pay 10% penalty and you will pay taxes on it as well. TSP is nothing more than a 401k for the federal government, as well as civil service and, of course, the military now as well. IRAs are nothing more than an individual retirement agreement, whether it's a traditional Roth, SEP, or simple. I'll cover those in a moment when it comes to retirement planning. They are an agreement between you and the IRS of when you pay taxes. That's really what it means. The IRA, traditional IRA, means you're going to postpone taxes on your principal and your growth until down the road. When it comes to Roth IRA, you pay taxes on your principal now, and you don't pay any taxes on your gains as long as you wait until 59 and a half or 5 years to have the account. That's the choice. A SEP IRA or a simple IRA, those are retirement accounts normally for small businesses. That's a retirement account for solo employees, or the solo ownership, whatever you want to call it, where you're the employee and the owner of your business. You may not be able to afford a 401k, even though you can set up a solo 401k. You can even set up a solo Roth 401k if you wanted to do that. But those are a little more expensive than a SEP or a simple IRA. Why would you do a small business solo 401k versus a SEP IRA? Well, it depends. So if I wanted to make sure that I could access some of the money via loan, you can do that with a 401k, even a solo 401k. With a SEP IRA, unfortunately, you cannot. With a Roth IRA, you can access the principal, that's the money you put in, at any time. The gains, though, you do have to wait until 59 and a half. Otherwise, you will pay 10% penalty in taxes. These are your limitations when it comes to IRAs. Just because you have 2 Roth IRAs does not increase this number. It is a total of $7,000 if you're under the age of 50 and $8,000 if you're over the age of 50 that you can contribute to that. If you're making better income than that, are there other options that you can build wealth tax-free? Yes, there is. And life insurance is a great way to build tax-free wealth. However, the catch is you have to be healthy enough to get it. That's the only catch that's there. Otherwise, it's a great way to help secure some of your money down the road that you don't have to pay any taxes on. And it's also non-reportable when it comes to those life insurance policies. They're also protected from litigation as well. So if I get sued, they can take my Roth IRA, they can take my traditional IRA, they can take my 401k, but they cannot touch my life insurance. So whatever money I have there cannot be touched by anyone but myself. So that's the advantage of having those accounts. These are those simple and SEP IRAs that I mentioned before. A SEP IRA allows you to put in more money, as much as a 401k. So I think it's around $65,000 or $67,000 per year that you can put into those. A simple IRA, you cannot put in as much money, and it's constructed a little bit different if there are employees. So that way you can offer something similar to a 401k, but not as costly as a 401k, because obviously there is a cost when you want to provide those types of accounts for yourself or your employees as well. Now let's talk about one last thing here. Because I mentioned this before. So there are ways to protect your assets when it comes to your 401ks, your 403bs, your TSPs. You can roll over that money into an annuity. Annuities have become very powerful vehicles for people, where they can have an index annuity, which guarantees no loss in the account. You can still have market-like returns, and you can have no fees. There are also registered index linked accounts are called RILAs, where you can roll money into those accounts and you can pick your floor. So if you want to have a 10% loss buffer, you can do that. You want a 20% loss buffer, you can do that. And whatever the markets are returning, they'll give you up to a certain cap or greater, and you can pick and choose what you want to do with that money. Whenever it comes to moving any money, again, it's about what you want to accomplish with it. It doesn't have to be a zero-sum game. So if you're sitting there and you have an old 401k, you're not sure what to do with it, but you're tired of seeing the fees taken out, you're tired of seeing the market fluctuate from time to time, you can move that money into an annuity. It will protect that money so you don't have to worry about it going anywhere. You can set up your own pension plan with those things as well. So there's a lot of choices when it comes to moving that money in preparing for your retirement years. And it doesn't take a massive amount either. You have a lot of choices with that. When it comes to cash value life insurance, I know people sometimes, don't understand this. They are an asset in your portfolio. Life insurance is outside of your employer. It's a great way that you can protect some of your money, grow your money, do it tax-free. You can also tie long-term care to your life insurance now, which is actually the biggest threat to your wealth today. And that long-term care, the cost of that will definitely become impactful should you need to, go on long-term care. That's if you cannot perform 2 of the 6 daily activities of living. So that's continence and toileting, transporting, bathing, dressing, and eating. So that can happen for many reasons. Heart attack, stroke, dementia, Alzheimer's, can happen from a car accident, complications in pregnancy. There's a lot of reasons why people would need long-term care. And that costs a lot of money, unfortunately. So now you can tie that to your life insurance, so it's no longer about if you live or you die. You can also take your life insurance and use it as collateral to get a business loan. So if you're interested in starting a business and you need some capital, get a life insurance policy if you're healthy enough to do that. You can use that as collateral. You don't have to put up your car and your house and those types of things. You can use your life insurance to do that. Walt Disney did that to buy the land in Florida for Disney World. And Colonel Sanders did that to start Kentucky Fried Chicken. They actually used their life insurance for that. So this is just an example of a growth rate for an index universal life where the client's earning a 7.1% rate of return. These do average higher than that, but this is just what we're showing. Putting in $500 a month, $6,000 a year. That's what this first column is right over here. And this is the cumulative premium. This is their cash that they're building, and this is what they have access to when it comes to their cash. And then, of course, they do have a death benefit as well. So this is what we're going to go off. Guaranteed means the market never goes up, but that's not what we're going to count on. We're going to count on the market doing something. So the money's going to grow. And by the time they're age 65, they put in $210,000. We're going to jump over here to the 7.1%. There's a little over $500,000 in cash and $1.1 million in death benefit and long-term care. They can then stop putting money in. The cash will still continue to grow. It will still continue to accumulate all the way until age 121. All of that money is tax-free. So, for example, if, let's say, at age 50, I get ready to send my children to school, that $165,000 I don't report on the FAFSA. That is non-reportable. Can I spend it on their college? I can. Unlike a 529, which is handcuffed money, it's specifically for education. This money I can access tax-free, question-free, penalty-free. It's money that I can do whatever I want with, and I do not have to pay it back. And then, of course, if I wait longer, that money's going to grow. If I wait, let's say, until age 75, I want to throw a big 75th birthday party. I have $901,000 in cash that I can do something with. Or I can have, if I pass away at that point, 1.5 million will go to my family tax-free. I develop Alzheimer's. I have 1.5 million in long-term care as well. So these have become very complex instruments, and it's about understanding at the end of the day, what do I have? How does it work? And what are my choices when it comes to that money? So, when you're talking about retirement planning or estate planning, there's certain pieces that you want to have in place. And I will tell you from experience, most people do not have everything. Some people have some things, some people have certain things, but they don't have everything. So my recommendation is to find a financial professional, talk to them, have them educate you on what you have, where your goals are at, and then what your choices are. A lot of times people treat us like we're the doctor. I don't like going to the doctor because they're going to tell me to stop eating this and start exercising, and I'm doing this wrong and everything. That's not what we're here to do. We're here to take money that you're already saving someplace and put it to better work for you so that they can accomplish the goals that you actually want to accomplish. If your goals are legacy planning, making sure that your kids are in a better position than you were, there's a lot of choices out there as well. Make sure that you get your will, your powers of attorney, your trust set up so that you can create that legacy so that they can have a leg up in life, unlike what we started with. And then that way you don't have to worry what future generations will look like in your family. Okay. So that's all of my information. Can I share my contact information? Is that okay?
Absolutely. You just took the words right out my mouth. I was going to say, Rob, excellent. Robert, I'm sorry. Like I know you, calling you
That's
Rob.
Okay. That's fine. I'm good with that.
I was going to say this conversation tonight was very much so needed. And that's where I was going. How can we get in contact with you?
Sure. Not a problem. Let me see if I have that slide deck up. I thought I did. Here we are.
I think I might be sharing already, Rob. I'm not sure if you see it. Is that your information there?
Did you? I don't see it.
You don't see it? Okay. I think it needs to be brought up. Do you have the ability to bring it up, Charlene?
I can share.
Okay, good.
Robert, you're able to share?
I can share it. That's my contact information.
Wonderful.
So if you take a picture of the QR code, that'll take you to an old picture of me. I know. I'm not catfishing anybody. It's just when I had hair. But it's an older picture of me, but that's the way you can contact me. That's my phone number. That's my email address. And, no matter where you're at currently, I am in West Palm Beach, Florida, but we do have an office there in the Greenbelt in Maryland. And we have 600 offices across the United States and Canada that we partner with. So no matter where you're at, if you want to see a real live person at a real live brick and mortar location, we should have a place near you. But if you want to do it virtually as well, that's no problem as well. It's free to do. So we provide a free review for anybody that wants one. And then it's up to them what they do with the information. If they want to take action, great, we can help them. If they don't, no problem. We're okay with that.
All right. Thank you, Rob. Yes, I just want to reiterate. Yes, I also think I have it up here. That's his phone number, his information there. You can contact him and the address. And yes, so we are part of the basically the campaign. Our mission is to educate 30 million by the year 2030. So our viewers, if you are familiar with these concepts and you want to help out in this mission, check us out. Maybe you can join the movement. And just to recap, there are some stats there of what Rob was talking about. I mean, type in the chats, our viewers. I want to see some participation. What do you think about Social Security? What are your needs of your retirement? You have learned a lot from the rule of 72 to using your life insurance as collateral. Who knew that, right? Follow the information. And here I just want to say that we do have the workshops through our financial literacy campaign. There we have the schedule. Here we have I invite everyone to come and check out the financial workshops. They are free 3 times a day, Monday to Friday, and you can actually scan the code to register for the workshops right there.
That's
If
what I
you
was
can
going to
just
ask
take a
Victor. How
picture.
can they get in contact with you?
Okay, absolutely. Here is my information as well. That is my contact, my email, my phone number. And if you are local, we actually are in Manassas. We have a financial center. We actually have about 630 centers across the nation. As a matter of fact, this Saturday, we have a big event where we actually inviting the public to anyone who wants to check us out in actions and see how these financial solutions are transforming the lives of many. We have 630 locations across from the East Coast to the West. So here is a local one in Manassas, Virginia. You can scan the code to register, but you can also contact. Let me get back to Rob's information, so you can also contact him, and so he can actually, if you are in Florida, like he mentioned, or any part of the country, you guys can assist on Saturday from 11 a.m. It's going to be powerful. About 700, over 630 centers coming and teaching us about all this information and the movement. We get the big picture of these instructors that have experienced more than 40 years of experience in the financial industry. So great opportunity. Yes. So yes. So I think you did. Of course, you have done an excellent job, Rob. I want to thank you for coming and educating the community. So yes, feel free to reach out to him so he can do a courtesy financial review free of charge. And again, here is his contact information.
Wonderful. Again, Robert, Victor, again, thank you so much for this conversation. Very much needed, especially in the times that we're in right now. You can never, I think Larry always said, if you stay ready, you don't have to get ready. I may have said it wrong, but for this topic, I definitely think that statement is extremely accurate when we talk about retirement. So again, Robert, Victor, thank you so much for joining us for our Thriving Thursday. Real quickly, before we end our conversation, I want to talk to you really quickly about what we got coming up. As normal or as usual, we want you to join us every Monday at 7:15 a.m. when we have our yoga with Tippy, getting those financial fitness tips. Also starting that week off with some movement. These days, I'm getting older. When I get up, I feel like I need WD-40. So if you feel like that, then this is a great program or a good thing for you on Monday to start with that yoga. Also, we have our next first-time homebuyers class is going to be December 13th. So, guys, that gives us approximately 30 days to get that room completely full. So, if you are currently working with any first-time homebuyers program, usually requires that you receive education. This is a class that you need to register for. Again, it's going to be at the McCourt Building in Woodbridge, December 13th. We want to see a packed house, okay? So, you can visit our website to register, or feel free to give us a call. I said in the beginning of our program that, hey, we wanted you to stay tuned to the conversation so you can find out how to get in contact with us. You can visit our website at www.firsthomealliance.org. If any of those services that I spoke about in the beginning, such as pre-purchase counseling, education, loss mitigation, rental counseling, if you or someone that you know needs those services, please visit us at www.firsthomealliance.org, or we want you to visit our website to register for our next first-time homebuyers class, which is December 13th at the McCourt Building located in Woodbridge, Virginia. Again, fellas, thank you so much for this wonderful conversation. We really appreciate the conversations that we've had with you, Victor, over the last, I think, 4 weeks. I mean, you showed up and showed out. And so we truly appreciate that. We look forward to talking to you both in the 2026 upcoming year. And again, for those of you, you can reach First Home Alliance at www.firsthomealliance.org, or shoot an email to help@firsthomealliance.org. That is it for tonight. We want to see you guys next Thursday as we continue our Thriving Thursday, our conversation. Again, fellas, thank you so much for joining us. And everyone, we wish you a wonderful weekend.
Thank you.
All right. Thank you. Thank you, everyone. Thank you, Rob.
Thank you, Victor and Rob.